Hi Tom, this is Stuart. Just wanted to shoot this quick video on the structured product. I know I told you last week I was going to get this to you. I was basically waiting for the July structured products to come out, but anyway, I only got the first release and it's not really what I was looking for. So I showed you the dual directional structure product, but I'm going to pull up one from, this one is from June. If you can see my chart, it's just the last month's offering of a 5-year JP Morgan balanced value dividends 5 index CD. Now, balanced value dividends, that is the name of the index. And so I'm going to show you, there are a bunch of these out here. So we have the 5-year Meridian, All American, Efficient Plus, Mojave. This one is the balanced value dividends. They all are leveraged to the upside, and these all have principal protection. But at the end of the day, these particular notes are not just linked to the CD. I was hoping that this balanced value dividends was going to be all stock, but it is a rules-based product that reduces volatility, that switches between stocks and bonds. So the upside hasn't been nearly as good as stocks, but this will still serve to, if we do get an index that is linked to the stock market, it'll kind of show you more along the lines of what principally protected means. So I'll just jump right into it. This green line would be the index. In theory, this could be the, this is the balanced value dividends 5 index, but if it were linked to the S&P, it would be the S&P. If it were linked to something else, it would be something else. And so what it basically says is you're going to get at least 100%, if not 115%, of the level of closing on the index price. So if the market is up 50%, or that index is up 50%, you will get 50% of your $1,000 investment. So if you invested $1,000, you'd end up with $1,500, perhaps $1,550 or $1,557 or whatnot. If the stock market is down, you get your $1,000 investment back. So that's pretty much what we are kind of looking for, is to make sure that we are principally protected. So it doesn't really matter how far down you are, you still get your $1,000 back and live to invest another day, while you get all of the upside and perhaps a little bit more if basically you have to wait till the end of the maturity to understand how the call option reacts, but this is how it works. And so I did create a little ebook on this, and let's see if I can pull this up on the fly here. Let me pull this up on the fly. So the way this basically works is, let's get to that spot over here. So how do they work? So basically, if you're buying $1,000, and here's my little write-up, it's 2 components: a zero coupon bond or a discount bond, and a call option. And so what you do is, if you buy $1,000, just roughly, maybe you buy $900 of the zero coupon bond and $100 of the call option for a total of $1,000. And so from here, this zero coupon bond will mature at $1,000. And so that's where you get your principal protection. And then this call option, that's the only real unknown about what's going to happen. And so you have 2 scenarios. If the S&P 500 is negative, then that call option goes to 0, because we bought a call, and of course you can't lose any more money than the call option that we bought. It's not leveraged to the downside. So upon maturity, the bond would mature at 1,000, and the call option would be worth nothing, so you get your money back, $1,000. If, on the other hand, the index were to go positive, and I have this as the S&P, let's say it's up 50% and you're leveraged by 5%, 1.05, the bond would still be valued at 1,000, and the call option would be worth 525, so you'd get 1525 to the upside. Okay? So that's basically how the principal protection works. So if the index is down, you get your money back, and if the index is up, you get a leveraged upside. Now, I'm not really that crazy about this more JP Morgan balanced value dividends, because when I looked a little further into this and frankly all the other products right now, they have reduced the volatility so much that the upside is not really that great. So I'm not really sold on this right now. If we could find a product that was linked a little bit more directly to the S&P 500, that would be worth something looking into. But the way it stands right now, I'm not really that big of a fan here. So I just don't think you're going to get this 65 or even 50% upside in even in 5 years the way this is structured. So frankly, I think you'd be better buying the S&P 500 and just sitting on it, and or even buying puts to protect it versus this particular structure, this particular index with this structure. So there you have it. That's a principal protected. So what I would recommend is if we found the principal protected link to S&P 500 or to some other index that has a little bit more volatility, if you have the principal protection in place and you get the upside, then that's what I'd recommend going for. Okay. If you have any questions, let me know. Hope you have a wonderful 4th of July, and I look forward to hearing your thoughts and chatting with you soon.